I need to ask you something, and I want you to answer it honestly, not to me, but to yourself. How many times have you entered a trade that felt right, felt certain, felt inevitable, only to watch it move against you the moment you committed? How many times have you sold in frustration, only to see the stock turn and run without you? How many times have you wondered whether someone, somewhere, knew something you did not? I am here to tell you, they did. And I am going to confess something that took me years and several fortunes to fully accept. For the longest time, I believed I was losing because of bad luck, because of bad timing, because the market was fickle, cruel, and unpredictable. I was wrong. I was losing because I did not understand who I was actually trading against. I did not understand that by the time I saw the move, by the time the setup looked obvious and the momentum felt undeniable. I was not catching an opportunity. I was being handed someone else's exit. That confession cost me everything before it saved me. And I am giving it to you now so you do not have to pay the same price. The market does not move randomly. Erase that idea completely. Every significant move, every genuine trend, begins with accumulation. It begins quietly, invisibly, long before the crowd has the faintest idea that something is happening. Large operators, institutions, funds, syndicates cannot simply buy millions of shares without pushing the price against themselves. So they act carefully, methodically. They buy weakness. They buy dips. They buy when others are fearful. They buy when news is bad. They buy when volume is thin and nobody is paying attention. I watched this across decades. Cotton, wheat, railroads, and the greatest bull markets ever seen. The pattern never changed. Before every major advance, there is a quiet phase, a sideways movement that bores the public into looking elsewhere. That boredom is not accidental. It is intentional. They want your attention elsewhere. They need your shares. And once they have accumulated enough, once supply is absorbed, the price moves. Not gently, but with conviction. It breaks out. It runs. Only then does the crowd notice. The crowd piles in. More buyers arrive, and who is selling into that buying? The same hands that accumulated quietly in the dark. This is not conspiracy. This is mechanics. This is how the game works. If you do not understand this cycle, accumulation markup, distribution, decline, you will be on the wrong side of it every time. You will buy breakouts as smart money sells. You will sell breakdowns as smart money buys. You will become the fuel for their profits. And you will blame the market when the truth is simpler. You did not understand the rules. I spent years getting destroyed by this cycle before I learned to see it, before I learned to read what the tape was actually saying, not what I wanted it to say. The tape is never wrong. Your interpretation is. Your emotions distort it. Your ego distorts it. But price, volume, and time always tell the truth if you know how to listen. Smart money leaves fingerprints in volume, in price action, in how candles form, close, reject, and confirm. Once you recognize those fingerprints, you are no longer blind. Let's start with what accumulation really looks like. There is a phase in every major move I call the quiet zone. It looks like nothing, just a stock moving sideways in a narrow range. No excitement, no story, no momentum. And that is exactly why smart money loves it. While the average trader looks away, institutions are working. They cannot place one large order. They must build positions over time. They buy during quiet sessions. They buy when volume is low. They buy dips and absorb selling from impatient traders. But they are not just buying, they are testing. Occasionally, they push price slightly higher. Not enough to trigger a breakout, just enough to test resistance. If heavy selling appears, supply is still high. They step back and continue accumulating lower. But if price holds and selling is weak, they know something critical. Supply is drying up. That is when the real move is near. Volume reveals this. High volume on down days during a supposed accumulation phase is a warning. This may be distribution, not accumulation. But low volume on down days is healthy. It means selling pressure is fading. Weak hands are gone. Strong hands remain. When you see range-bound price, declining volume on dips, and subtle resistance tests, you are watching accumulation in real time. The best trades are not entered on excitement, they are entered on patience. You wait until the stock tells you clearly that control has shifted from sellers to buyers. Then you act decisively. This brings us to the pivot point. A pivot is when price breaks out of a defined range with authority, strong volume, follow-through, and confirmation. This is when smart money wants the crowd to notice, not before if they are already positioned. The pivot is the invitation. By that point, smart money is no longer aggressively buying. They are holding and preparing to distribute into the crowd's demand. This is why blindly chasing breakouts is dangerous. Not every breakout is real. Some are engineered to attract buyers into positions that will fail. You need context. Was there a proper base? Was there true accumulation? Did volume contract during the base and expand on breakout? These are the questions that separate survival from failure. Understand this clearly. Smart money does not always win immediately. Markets are complex. There are false starts. But over time, the pattern holds. Accumulation precedes advance. Distribution precedes decline. If you can identify where the market is in this cycle, you gain a massive edge over those reacting to headlines. Volume is the market's lie detector. Price can be manipulated short-term. Volume is harder to fake. Rising price with strong volume equals strength. Rising price with weak volume equals caution. Falling price with heavy volume equals real selling. Falling price with light volume after a rally equals selling exhaustion. Read volume, it tells the truth. Most people will understand this intellectually, then ignore it emotionally. They will buy because they like a stock. They will sell out of fear, they will miss accumulation and chase the top, not because they lack intelligence, but because they lack discipline. Understanding and execution are not the same. Now what happens after accumulation are not the same. Now what happens after accumulation? The markup phase begins. Price rises, volume increases, news turns positive, analysts raise targets, social media explodes, the crowd arrives, late as always, confidence grows. Positions increase, euphoria builds, and quietly, methodically, smart money begins selling. Not all at once, they cannot. They distribute gradually, using the crowd's buying to exit. This is distribution, the mirror image of accumulation. It often looks like strength. Price may still rise or move sideways near highs. Volume may be high, but beneath the surface, shares are transferring from strong hands to weak ones. The foundation is being removed. Then comes the decline, sometimes sudden, sometimes slow. At first it looks like a dip, then a pullback, then an opportunity. The crowd buys more, averages down, and eventually loses not just profits, but capital. This is why most traders lose, not because the market is rigged, but because they are consistently on the wrong side of the cycle. They buy what smart money sells, they sell what smart money buys. They follow emotion instead of reading the signal. And until that changes, nothing else will. Not just the profits they never truly had, but the very capital they started with. I have seen this happen more times than I care to count. I have lived through it. I have contributed to it on some of my worst days. And I want to be very direct with you. The reason most people lose money in the markets is not because the markets are rigged. It is because they are consistently on the wrong side of the cycle. They buy what smart money is selling. They sell what smart money is buying, and they do it because they follow emotion, follow the crowd, follow the noise, rather than reading the signal. In our video, The Signs You're Finally Becoming a Profitable Trader, we discuss the internal shift that occurs when a trader stops chasing and starts observing, when they begin to respect the market rather than fight it. If you have not seen that yet, I strongly encourage you to watch it after this one, because the technical knowledge you have learned today is only half the battle. The other half is the battle within you, the battle between patience and panic, between discipline and desire, between the trader you want to become and the habits that are holding you back. Here is what I want you to take from everything I have shared. The market is not your enemy. The market is indifferent. It does not know your name. It does not care how long you have been trading. It does not care how intelligent you are, how much money you need, or how certain you feel about a position. The market is simply the sum of millions of decisions. And within those decisions are the large, deliberate, patient actions of those with the most information and the most capital. Your job, your only job, is to read those actions, to recognize the phases, to enter when smart money is still accumulating, not when the crowd has already arrived, to exit before distribution becomes obvious, to think in cycles, not in moments. This requires something most people are unwilling to do. It requires sitting still. It requires watching without acting. It requires letting a setup fully develop before committing capital. It requires the humility to admit when you are wrong and to exit without revenge trading. And it requires the patience to hold a winning position without grabbing small profits before the real move unfolds. None of this is natural. All of it is learned. And that learning does not come from videos alone or from reading books. It comes from real trading, real decisions, real losses, and real wins. It comes from developing a deep understanding of your own mind, understanding how it deceives you, how it amplifies fear and greed at exactly the wrong moments, how it creates certainty where none truly exists. That is why I want to introduce you to two resources we have created, not as afterthoughts, but as essential companions to everything you have heard today. The first is our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. This is not a collection of tips. It is a deep exploration of the mental framework behind great trading. The principles forged through decades of wins and devastating losses, organized for the modern trader who is serious about this craft. It will challenge how you think about money, markets, and yourself. The second is the Livermore Journal, a 9-0 day trading psychology workbook. Because reading about discipline is not the same as building it. This is a daily practice, a structured commitment to tracking your decisions, identifying your patterns, and replacing destructive habits with deliberate ones. If you want to trade like a professional, you must think like a professional. And this workbook bridges the gap between intention and execution. Let me leave you with this. You already have enough intelligence to become a great trader. You do not need another indicator. You do not need a hot tip. You do not need to predict what central banks will say next week or which sector will move next. What you need is clarity, the patience to see clearly, the courage to act on what you see, the discipline to protect yourself when you are wrong. Smart money is not smarter than you. They are simply more patient, more disciplined, more honest with themselves about what the market is actually saying. Develop those qualities not as ideas, but as daily practice, and the market will begin to reveal itself to you in ways you cannot yet imagine. The moves were always there. The signals were always there. The only thing that changes is whether you have the eyes to see them. And now you do.